Welcome back to Abhik Parth. Today, we dive into Chapter 11 of the Little Book of Common Sense Investing by John C. Bogle. This chapter is a crucial lesson for all investors. Avoid the temptation of speculation and stay true to your long-term investment plan. Let's explore why speculation is dangerous and how you can protect yourself with some real-life examples. Key Lesson 1: The Dangers of Speculation. Speculation means trying to get rich quick by predicting short-term market movements. It's like gambling, exciting but highly risky. Speculation often leads to emotional decisions, losses, and regret. Example 1: Chasing hot stocks. Rohit heard about a hot tech stock from a friend and invested 1 lakh rupees in it. Initially, the stock doubled, but soon after, the company faced losses and the stock price crashed. Rohit lost most of his money because he bet on hype instead of fundamentals. Key Lesson 2: The Difference between Investing and Speculation. Investing focuses on long-term growth through diversified, low-cost index funds. Speculation relies on timing the market, stock picking, and following trends, which rarely work in the long run. Example 2: The Steady Index Investor. Ananya consistently invested in a diversified index fund for 15 years, ignoring market noise. Her portfolio grew steadily to 40 lakhs rupees. Her friend Rajiv, who jumped from stock to stock, ended up with only 20 lakhs rupee due to bad decisions and high trading costs. Key Lesson 3: The Role of Luck in Speculation. Bogle reminds us that short-term success in speculation is often due to luck, not skill. But luck doesn't last forever. Even professional fund managers fail to consistently outperform the market. By speculating, you risk turning your investments into a losing game. Example 3: The Fund Manager Trap. Amit decided to invest in actively managed mutual funds. Over 5 years, the fund performed well, but high fees ate into his profits. Meanwhile, his sister Preeti invested in a simple index fund and earned higher returns with lower costs. Key Lesson 4: The Emotional Trap of Speculation. Speculation triggers fear and greed. Greed makes you chase the next big thing. Fear causes panic selling when the market drops. Example 4: Emotional investing gone wrong. Meera invested heavily in cryptocurrencies during a market boom, hoping to become a millionaire overnight. When prices crashed, she panicked and sold at a massive loss. If she had invested in index funds, her money would have grown steadily and securely over time. How to avoid the siren song of speculation? Stick to index funds, focus on low-cost, diversified index funds instead of individual stocks. Stay disciplined, avoid the temptation to time the market or chase trends. Invest for the long term. Time in the market is more important than timing the market. Ignore market noise, block out hype, tips, and short-term predictions. Example 5: The Long-Term Winner. Sanjay invested 5,000 rupee per month in an index fund for 20 years. Despite market ups and downs, his disciplined approach helped him build a 1 crore rupees portfolio. His friend Karan, who kept jumping in and out of the market, ended up with only 30 lakhs rupees due to poor timing and high costs. Speculation may seem exciting, but it's a dangerous game that most investors lose. By focusing on disciplined, long-term investing and avoiding the noise, you can build real wealth over time. Remember, Slow and steady always wins the race. Movie camera. In the next chapter, we'll uncover the timeless principles of long-term wealth creation. Don't forget to subscribe to Abhik Parth, like this video, and share it with your friends. Speech balloon question for the audience. Have you ever been tempted to speculate? Share your experiences in the comments below. Welcome back to Abhik Parth. Today, we are diving into the final chapter of the Little Book of Common Sense Investing by John C. Bogle. This chapter focuses on the power of simple math in investing and why being realistic with your expectations will help you succeed in the long run. Let's break it down with practical examples to bring these lessons to life. Key Lesson 1: The Arithmetic of Investment Returns. John Bogle explains that your returns come from two components. Investment returns, the actual performance of the companies in your portfolio, like dividends and earnings growth. Speculative returns, changes in the price investors are willing to pay for the earnings, market sentiment. Example 1: Realistic versus unrealistic returns. Rahul invested 10 lakhs rupees in an index fund that historically offered a 10% return. Instead of expecting his money to double in 2 years, Rahul patiently allowed compounding to work. Over 10 years, his investment grew to 25 lakhs rupees. Meanwhile, his friend Arjun speculated on high-growth stocks expecting 50% yearly returns. He lost most of his capital due to unrealistic expectations and poor stock choices. Key Lesson 2: The Cost Matters Hypothesis. Bogle stresses that investment costs, like expense ratios, management fees, and trading costs, directly reduce your returns. A seemingly small 1% annual fee can eat away 25%, 30% of your returns over 30 years. Example 2: Costly active fund versus low-cost index fund. Sneha invested in a low-cost index fund with a 0.2% annual fee. After 20 years, her 5 lakhs rupee investment grew to 15 lakhs rupees. Priya chose an actively managed mutual fund with a 2% fee. Her 5 lakhs rupees only grew to 10 lakhs rupee due to high fees. Moral: always choose low-cost funds to maximize your returns. Key Lesson 3: The Rule of Humble Expectations. Bogle advises investors to adopt realistic expectations. Historically, stock markets have delivered average annual returns of 7%, 10%. Expecting much higher returns can lead to risky behavior. The market rewards patience and discipline, not greed or unrealistic ambition. Example 3: The 8% Reality Check. Rajesh invested 1 lakh rupees every year for 20 years, expecting an 8% average annual return. His realistic approach helped him accumulate 50 lakhs rupees. On the other hand, Ravi expected 15% returns and invested in speculative schemes, which led to frequent losses. Key takeaway: base your investment plan on historical averages, not hype. Key Lesson 4: Compounding is your best friend. Time in the market is far more powerful than trying to time the market. Compounding works wonders when you remain invested for the long haul. Example 4: Compounding in action. Meera started investing 5,000 rupee per month in an index fund at age 25. By the time she turned 55, her portfolio grew to 1 crore rupees. Her brother Vikram waited until 35 to start with the same 5,000 rupee monthly investment. At 55, his portfolio was only 50 lakhs rupees. Lesson: start early, stay consistent, and let compounding do the heavy lifting. Key Lesson 5: Ignore the noise, trust the numbers. The financial media often exaggerates market movements to grab attention. Stay focused on the math, not the noise. Long-term investing based on humble arithmetic always beats emotional decisions. Example 5: Media hype versus discipline. During a market crash, Shweta ignored headlines like "Market Doomsday Ahead" and continued her systematic investments. Her disciplined approach helped her portfolio recover and grow significantly in the long term. Her friend Samir panicked, sold his investments at a loss, and missed the market recovery. In this final chapter, Bogle reminds us that the simple truths of investing are often overlooked in favor of complexity. Costs matter, compounding works, and patience pays off. Success in investing doesn't come from beating the market, it comes from participating in it wisely and consistently. Movie camera. This concludes our journey through the little book of common sense investing. Thank you for tuning in to Abhik Parth. If you found this series valuable, please subscribe, like, and share with your friends. Speech balloon question for the audience: what's the most important lesson you've learned from this book? Drop your thoughts in the comments below.